You're actually carrying around a shared belief, That's the secret. It's a story we all agree to trust. Long ago, we swapped things directly, which was pretty clumsy, so people started using objects that were rare or beautiful. That rarity gave them value. Think about that for a moment. Metal became the favorite because it's durable and divisible. Coins were born when someone stamped a promise on metal. Here's where everything changed. That stamp was a guarantee. It meant the weight and purity were officially verified for you. But carrying heavy coins got risky for large purchases, honestly. So trusted goldsmiths started storing people's gold for safekeeping. They'd give you a paper receipt for your gold deposit. Soon, people just traded the paper notes instead of the gold. The goldsmiths noticed not everyone claimed their gold at once. This is the part nobody expects. They started lending the extra. They created new money from the gold just sitting there. That was the birth of modern banking. Sounds familiar, right? Governments eventually took over this note printing role completely. They promised to exchange notes for gold on demand. But that promise got broken during major crises, We moved to fiat currency, which has no physical backing. Its value comes solely from government decree and our collective trust. So who controls how much of this money exists now? That's a central bank's main job. They manage the supply. They can create new electronic money, which is most money today. Have you noticed this? Your salary is just numbers in a computer. Your mortgage is a large digital entry in your bank's ledger. This system runs on confidence. If that fails, the value plummets. We call that hyperinflation. It's when trust completely evaporates. So banks also create money whenever they issue a new loan. They don't lend out other people's deposits. Not really. They create a new deposit in the borrower's account from nothing. That new digital money enters the economy when it's spent. This is the part nobody expects. Money is mostly debt, honestly. The interest on that debt drives the need for economic growth. Why do you think that system feels so relentless sometimes? Governments also influence value by adjusting interest rates, Higher rates make saving more attractive and borrowing more expensive. This slows down spending and cools off an overheated economy. Lower rates do the opposite, encouraging people and businesses to borrow. International trade adds another layer. Currencies float against each other. A country's economic health dictates demand for its currency. Traders buy and sell currencies in a vast, global electronic market. This market sets the exchange rate you see for travel. Governments sometimes fight this market to control their currency's value. They might buy their own currency using foreign reserves, for instance, or they might sell their own currency to weaken its value. A weaker currency makes a country's exports cheaper for foreigners, but it makes imports, like oil or food, more expensive locally. You can see the direct impact on everyday life, right? Now, what about the cash in your pocket? It's special. It's the only money that's a direct central bank liability. Digital money in your account is your bank's promise to pay. This distinction matters during a banking crisis, Governments ensure deposits to maintain that crucial public trust. Here's where everything changed again. The invention of digital networks. Money became pure information, moving at the speed of light. Your card swipe is just a message between computers. Those computers settle the transaction later, often at night. Why do you think old checks took days to clear? They literally had to move the physical paper between banks. Now, let's talk about inflation. It's not just prices rising. It's the value of each currency unit slowly eroding. A little inflation is normal in a growing economy, honestly. But it's a hidden tax on everyone holding cash. This encourages spending or investing instead of hoarding money. Central banks target a low, stable inflation rate on purpose. Deflation, or falling prices, is actually much more dangerous. It makes people delay purchases, waiting for cheaper prices tomorrow. That crushes business revenue and leads to job losses. So, the system is designed to gently push prices upward. This brings us to the concept of money velocity. It's how quickly money circulates through the economy. Faster velocity means more transactions and more economic activity. During recessions, velocity drops. People and businesses just hold on to cash. This is the part nobody expects. Banks can become hesitant too. They tighten lending standards, which slows money creation down further. Central banks then try to jumpstart the cycle with low rates. Have you noticed how asset prices often inflate first? That new money often finds stocks or houses before groceries. This can increase inequality, which is a real political problem. Now, what happens when countries share a currency? They lose a key adjustment tool, their own exchange rate. A struggling region can't devalue its currency to boost exports. They can only cut costs internally, which means lower wages. That creates major tension within the currency union, It's a trade-off between unity and local economic control. Let's talk about cryptocurrencies. They're a direct challenge to this system. They remove the central bank and the trusted middleman entirely. The trust is placed in code and a decentralized network. New coins are created or mined by solving complex puzzles. The supply is usually capped by algorithms, not human committees. This appeals to people who distrust central authority, honestly, but it creates wild volatility. which hurts its use as currency. Would you accept a salary in something that might have in value? Governments are now responding with their own digital currencies. These would be a digital version of cash, not a bank deposit. It gives the state more visibility into the money supply. That raises privacy concerns for a lot of citizens, naturally. So where does this leave us today? The system is evolving. Look, the core function of money hasn't really changed, though. It's still a medium of exchange, first and foremost. It's a unit of account for pricing everything uniformly. And it's a store of value, at least we hope so. But its form keeps shifting from physical to digital. Here's the thing. All systems depend on that initial trust. When that erodes, people return to tangible assets quickly. Think about that for a moment. Why is gold the classic fallback? It's chemically inert, so it doesn't corrode over centuries. Its supply grows slowly, unlike paper money a central bank can print. But it's impractical for daily use. You can't buy coffee with it. So we've built this entire layered system on top of it. Commercial banks, payment processors, and networks form the infrastructure. They each take a small fee for enabling the transaction. This is the part nobody expects. Your data is part of the fee. Your spending habits are valuable to marketers and lenders. Cash is anonymous, which is why some governments dislike it. Digital trails help combat crime and tax evasion, they argue. But they also enable unprecedented surveillance of citizens' lives. This tension between privacy and control is a modern battle. Now, let's discuss what backing a currency really means today. It's not backed by gold, but by all goods and services. The strength of an economy ultimately backs its money. A currency from a productive, stable nation is in higher demand. That's why political chaos usually destroys a currency's value. Investors and savers seek safety in more stable currencies. This flight to safety can drain a country's foreign reserves fast. Have you ever wondered about the cost of manufacturing cash? It uses special paper, inks, and security features like holograms. This is to prevent counterfeiting, which is just unauthorized money creation. Counterfeiting directly steals value from everyone holding that currency. So the state fiercely protects its monopoly on issuing cash. Digital money faces a different threat: cyber attacks and hacking. Banks spend fortunes on digital security to maintain your trust. A successful large-scale hack could undermine the whole digital system. This is why backups and insurance exist at every level. Now consider the human effort behind maintaining the system. Auditors, regulators, clerks, and software engineers all play a part. It's a massive, costly apparatus just to move abstract value around. Here's where everything changed. The move to near-instant digital settlement. The speed itself changes how we think about money. Immediacy reduces the friction and maybe the thought behind spending. Savings can be transferred to investments with a few taps. This democratizes finance, but also increases risk for novice people. Financial literacy becomes crucial when money moves this fast, you know. Why do you think payday loan businesses thrive in this system? They bridge the gap between instant digital spending and slow pay cycles. They charge high fees for that bridge, trapping some in debt. The system's speed benefits some and exploits others, honestly. So, is the current system the final stage? Probably not. We're already seeing the next shift: programmable digital money. Imagine money that only unlocks for a specific approved purchase. Governments could use this for welfare or stimulus spending. The funds could only buy food, not alcohol or other items. This increases efficiency, but also control over citizens' choices. Corporations might issue their own tokens for use in their ecosystems. You'd earn and spend within their walled digital garden. This fragments the idea of a universal currency, doesn't it? Meanwhile, the physical infrastructure of cash is slowly declining. Here's the thing. This excludes people without tech access or skills. Financial inclusion becomes a major challenge in a digital-first world. What about barter? It never truly disappeared, you know. Local exchange trading systems create small, informal currency networks. These work on mutual credit, not issued currency or cash. They prove that trust within a community can be enough. This is the part nobody expects. Global reserve currencies dominate trade. Commodities like oil are priced in US dollars worldwide. That creates constant global demand for dollars, strengthening its position. It gives the issuing country enormous financial and political power. This exorbitant privilege comes with serious responsibilities, though. Their monetary policy decisions ripple across the entire globe. Emerging economies often suffer when the reserve currency tightens. Their debts in dollars become much harder to repay, honestly. Some countries are now openly seeking alternatives to this. They discuss using baskets of currencies for trade between them. This could reduce their vulnerability to a single nation's policies. But building that alternative system takes decades of coordination. Think about that for a moment. Is money a force for good? It enables cooperation on a scale otherwise impossible, for sure. It also fuels greed, inequality, and devastating financial crises. It's a tool, and like any tool, its use defines it. The future likely holds a hybrid system for a long time. Central bank digital currencies, private crypto, and old cash will coexist. Regulation will struggle to keep pace with technological innovation. The cat and mouse game between regulators and innovators will continue. Have you noticed how money shapes your own daily decisions? It influences your career path, where you live, and your stress. That's the ultimate power of this shared social agreement. It allocates resources and human effort across the entire society, sometimes efficiently, other times with brutal and wasteful outcomes. We built the system, and we can choose to change it. Reform is slow and politically difficult, but it's not impossible. New ideas about universal basic income test money's purpose. Is money a reward for labor or a right of citizenship? That debate will define the next chapter of currency. So, how does currency work? It's a constantly evolving story. It works because enough of us believe in the story. We trust the numbers in our accounts represent real future value. That trust is the most delicate and essential part of all. And that's the simple, complicated truth of how currency works.